Gold and its true price. When you hear headlines like gold hits a new record at $3,500 per ounce, it can trigger an immediate reaction. Some people feel excitement, others feel panic, and many think the same thing. Did I miss the boat? But the truth is that the number you see on the screen is only the beginning of the story. That price is the nominal price. It doesn't automatically tell you what gold is worth in real terms. Inflation changes what money means over time, so comparing today's price to yesterday's price without adjusting for purchasing power can be misleading. In other words, a record can sound dramatic, but it may not represent a true historic extreme once you consider what dollars can actually buy. Gold as a store of value. Now, why does gold keep coming back into the spotlight? Because it has a special role in human history. Gold is not just a commodity, it's a long-term store of value. It survives currencies, financial crises, policy mistakes, and even the collapse of empires. Paper money changes, governments change, systems change, but gold remains recognizable, tradable, and durable across centuries. That's why people often turn to gold in uncertain times, not necessarily to get rich quickly, but to protect wealth when trust in the financial system weakens. At its core, gold is closely linked to confidence. When confidence drops, gold often rises. Purpose of analysis. So what are we trying to do in this presentation? We're trying to see the full picture. We'll compare nominal prices with inflation-adjusted prices to understand what records really mean. We'll also look at gold's role inside the modern financial system, including how it's traded, how price signals are created, and why the market sometimes behaves in surprising ways. And finally, we'll connect all of that to expert views and long-term trends, because gold isn't just about today's chart. It's about time. It's about how value survives through decades. If you want to understand gold, you need more than a headline. You need context. Nominal versus real price. Let's start with one of the most important ideas in investing, the difference between what a price says and what it means. In 1980, gold peaked around $850 per ounce. That sounds tiny compared to $3,500 today, until you adjust for inflation. In today's money, that $850 is closer to about $2,800. That changes the story completely. It means that some of the biggest true peaks in gold happened in 1980 and again in 2011. So when we say today's price breaks records, it may only be slightly surpassing those historic moments once inflation is included. This is why inflation-adjusted thinking is essential. It protects you from being fooled by big numbers. Long-term growth. Now, zoom out even further. Since the end of the gold standard in 1971, gold has grown by roughly 7 to 8% per year in real terms, on average. That doesn't mean it rises smoothly. It doesn't. Gold moves in cycles. It can surge fast, then go quiet for years. But long-term, it has shown an ability to keep up with, and often outpace, inflation. And the reason isn't magic. It's behavioral and systemic. Gold tends to respond when uncertainty rises, when debt expands, when currencies feel weaker, when markets become unstable. It's not an asset designed for quick flipping. It's a stability asset, something people hold when the future feels less predictable. Trust and monetary systems. This brings us to the real engine behind gold, trust. Gold is not just reacting to inflation, it's reacting to confidence in the monetary system. When investors fear that currencies are losing credibility, they look for something outside the system. That's why central banks matter here. When central banks increase gold holdings, they're signaling something important. They want reserves that are not dependent on another country's promises. Confidence drives demand, and demand drives price. So if you want to understand gold, don't only watch inflation, watch trust. Because gold is, in many ways, a mirror. It reflects how safe people feel about money itself, how gold prices are set. When people think about the price of gold, they often imagine something simple: supply, demand, and a number on a chart. But in reality, the process is much more structured and global. One of the key institutions behind daily pricing is the London Bullion Market Association. For over a century, London has played a central role in determining benchmark gold prices used worldwide. These prices influence trading, investment decisions, and even central bank strategies. Every day, the global gold market aligns around these reference points. That means the price of gold is not random, it is the result of coordinated financial activity across continents. Paper versus physical gold. But here is where things become more complex. Not all gold trading involves real physical metal. In fact, a large portion happens in the world of paper gold. On exchanges like COMEX, investors trade gold through futures contracts, ETFs, and other financial instruments. The volume of these trades often exceeds the amount of physical gold that actually exists. This doesn't mean the system is broken, but it does mean that price formation is influenced not only by real supply and demand, but also by expectations, speculation, and financial positioning. In many ways, gold behaves like both a commodity and a financial asset at the same time. Market reality. We saw how important this distinction is in 2020. During the pandemic, demand for physical gold surged, and reports emerged that some vaults struggled to meet delivery expectations. This revealed a key reality. The gold market is a mixture of physical metal and financial promises. Prices can move based on fear, liquidity, and investor behavior, not only on mining output. Understanding this helps explain why gold sometimes rises even when production increases, or why prices can drop despite strong demand. The gold market is not only about metal, it's about psychology, finance, and trust combined. Gold versus real estate. To understand gold's real power, we need to compare it to everyday assets. Let's take real estate. In 1971, the average American home cost about 500 ounces of gold. Today, that same house can be purchased for roughly 200 ounces. That means something surprising. In terms of gold, housing has actually become cheaper over time. This doesn't mean houses lost value, it means gold preserved purchasing power. Instead of measuring price in dollars, we measure it in ounces. And when we do that, we see a completely different story. Gold becomes a benchmark of value across decades. Gold versus consumer goods. The same pattern appears with consumer goods. In 1980, a Mercedes S-Class cost about 10 ounces of gold. Today, it costs closer to 8 ounces. Again, gold's purchasing power remained remarkably stable. This doesn't mean gold always rises in price. It means it holds value relative to real products. When currencies change, gold often acts like a measuring stick. It helps show what money can actually buy. And that is why economists often analyze gold not as a luxury item, but as a long-term reference point. Gold versus stocks. Now let's compare gold with stocks. Over the long run, stock markets like the S&P 500 have delivered higher returns than gold. But those returns come with volatility, crises, and taxation. When we account for inflation, financial crashes like 2000, 2008, and 2022, and the emotional difficulty of staying invested during downturns, gold looks different. It may not grow as fast, but it preserves value. Gold is not an asset designed to outperform everything. It is designed to survive. And in finance, survival is sometimes the most important return of all. Taxation of gold. When people talk about investing in gold, they often focus on price, timing, and market trends. But one of the most important factors is often overlooked: taxation. Tax rules can significantly affect how profitable a gold investment really is. Different countries treat gold in very different ways, and these differences can influence where investors choose to buy and store their assets. Understanding tax frameworks is not just a technical detail. It can change long-term returns and investment strategies. European gold markets. Europe offers some interesting examples. In Germany, investment-grade gold is exempt from VAT, which makes it attractive for buyers across the continent. Switzerland, on the other hand, is famous for its stability and security. Investors can buy gold with minimal restrictions and store it in high-security vaults known worldwide. These policies create strong gold markets and attract international investors. Geography, law, and financial tradition all play a role in shaping where gold flows. United States tax rules. In the United States, gold is classified as a collectible. That means capital gains can be taxed at rates as high as 28%, often higher than the tax on stocks. This affects investor behavior. Some people hold gold long-term to delay taxes, while others structure purchases differently to optimize returns. The key lesson is simple. Gold investing is not just about buying metal. It is about understanding the full financial ecosystem, markets, regulations, and taxes together.